Thank you for this very kind introduction. Let me first thank the organizers for inviting me. I would like to present a paper on incentives and moral hazard that is, of course, as I think most papers nowadays, the result of a reflection on the current crisis. So, this is joint work with Jean-Charles Rocher, which used to be in Toulouse and is now in Zurich University. And we will use basically a theoretical framework to have a reflection on banks' manager compensation. So, of course, as motivation, what we have seen with a number of financial institution bailout, and how in particular we had systemically important financial institutions for which it was impossible to do anything but bail them out, right? And this, of course, has led to the sentence that the Treasury was held hostage of a large financial institution, which definitely is quite a realistic description of what was going on at some point in the crisis. So what we would like to consider is the theoretical issue about these systemically important financial institutions that know that they will be bailed out. Consequently, they may have incentive to take excessive risk. And so how could we provide the right incentives to bank managers to take low risk and to have safe and sound banking? And of course, one extreme solution would be to have enough capital, but we are thinking of a framework where the extent of the bailout is such that it would not be efficient to hold this incredible amount of capital. So we need other types of approach. And this is what I would like to explore here. So the incentive issue, well, first we have seen banks that have this payout policy. In terms of manager compensation, we have seen how generous the manager compensations were, and the media have brought out the data that are quite spectacular. But it's clear that it's inefficient to make transfers from the taxpayers' money into the manager's money, and therefore there seems to be something that's not correct in the whole process. So that bank manager has quite a generous package, if it's okay with the shareholders, would be okay with us, theoretically. But then, in practice, what we see is quite a generous payout policy. Also, as part of the payout policy, the dividend payout in 2007 was quite generous, as established in a paper by Viral and with Gushral and Shin. And so indeed, it seems to be the case that payout policy was quite important in all this. Then, of course, we may say, well, maybe this is just because corporate governance is incorrect. But if this was the case, then let's go for Basel corporate governance rules for banks, right, which are quite specific, and that would solve the whole thing. But I'm afraid things could be much more complicated. It may be the case that, after all, shareholders benefit from this generous payout policy, in which case you can reform corporate governance as much as you want. If corporate governance reflects shareholders' view, then things will not change. So one thing is clear is that limited liability for a systemically important financial institution means that shareholders will never pay for the full damage they inflict on society. And therefore, this is a basic fact from contract theory, and I think it's Cheval that in the 80s wrote about this point. Therefore, it means this dilutes the incentive to take the right decisions, to take the right level of effort to prevent damage. So, we are going to consider systemically important financial institutions, which some years ago were the too big to fail institutions. Now they have included the too interconnected to fail and the too complex to fail, large complex financial institutions. And what we do have is empirical evidence on the cost of funding for the too big to fail institutions, and this is clearly the case that too big to fail institutions have an advantage in their funding as they don't pay the risk premium they should pay in terms of the composition of their portfolio, right? So O'Hara and Shaw, Morgan and Styro have shown this, and therefore this means that if it was just for this reason, introducing a tax on too big to fail would be efficient, so as to reestablish somehow, a plain level field. Regarding the recent evidence, we have seen a number of bailouts, and what we have observed is that shareholders have not been wiped out, but well, of course they have had losses, but we are quite far from a serious bankruptcy procedure, right? Ideally, a bailout should be speedy and should preserve the long-term incentives for the managers and shareholders. In fact, the interventions we have seen in the recent crisis were speedy, but regarding the preservation of the right incentives, they were far from ideal. So of course, the way in which we resolve a crisis could be more or less efficient. The example of the Swedish crisis resolution is seen as one of the best one, and in this case, it was the case that shareholders were wiped out once the institution was declared insolvent, right? So it was much proper in terms of incentives. So if we know that it is not credible that a too big to fail bank will not be bailed out, then it means that we have to consider taxing systemically important financial institutions in order to have the funds to provide the future bailout. But the question is then, will we preserve the incentive for the managers to take a safe and sound view of their investment? And so that's the exercise we want to go into. And this, of course, will be quite close to the idea of capital insurance that have been put forward by Kashyap, Rajan, and Sai. Let me clarify that on this issue of taxing, we are not considering a Pigouvian tax as Viral did in his presentation of yesterday with their paper, which could be ex ante quite efficient. We are thinking more in terms of insurance, right? So the funds will have to be provided to those institutions, so let those institutions pay ex ante for those funds. So what we want to consider is a cascading problem. And why? Well, because the regulator will set the rules of the game, the rules of the ex ante, the rules of the bailout with the bank shareholders, but then bank shareholders will write the contract with the bank manager, and the contract will specify the manager's compensation. So that's what I refer to as a cascading problem, because there is no direct link between the regulator and the bank manager. And the whole question is, well, ideally, we would like to complement the invisible hand with a number of taxes, with a number of regulatory measures, but we wouldn't like to go all the way into intervening on how to structure managers' compensation, right? And of course, the idea is we don't want to teach a banker how to do his job. So we would like, if possible, not to intervene in the compensation package. But the question is this possible? And that's what we would like to explore. So in fact, we show that when we consider this type of tax or insurance scheme so that the premium will pay for the bailout, this may not be sufficient to restore financial stability and may lead to too much risk. And second, even if having a fairly priced capital insurance or fairly priced tax is a necessary condition, it is not sufficient. This is related to a number of papers, and so Shapiro and Stiglitz is the reference in the labor market. Korcher-Lakota and Shim consider the dynamic incentives in terms of closing down, liquidation versus continuation of banks. And a number of models have developed use this technology of dynamic moral hazard. So we consider the simplest model we may think of, where banks obtain a cash flow, and then with some probability, the bank incurs a very large loss. We assume the project is profitable, positive net present value, and the key thing is that limited liability implies that the choice of the shareholders is to use the limited liability option. Rather than recapitalize the bank by paying the losses are so large that shareholders prefer to drop the bank altogether, right? And therefore it will be, because the bank is too big to fail, it will be the government, the treasury, that will have to intervene and pay the bill. This is combined with moral hazard, so that the manager has the choice whether to have a low level of risk or a high level of risk. And moral hazard is modeled in such a way that if the manager takes a high level of risk, it has some private benefits. And I like to refer, and in the context of the crisis, I like to think of these private benefits as related to fake alpha and managers' compensation. Okay, so this is a timeline of events. So at each, it's an infinite time model. At each point in time, the manager could be kicked out or could remain in place, and then we observe whether there is a crisis or not. And depending on whether there is a crisis or not, they enter the next period, and the manager might be kicked out or not. So let me consider two alternative bailout procedures before telling you about the optimal contract. So the first one is simply penalize nobody, right? So we keep the shareholders as they are, we pay every debt, and this, of course, will be an idea of maximizing total surplus, right? So since this will be a transfer from one type of agent to another, then it will be a possibility. I don't think this is the objective function we have in mind, because we think taxes are a distortion, and therefore this is not the best way to account for social welfare, but still it will be what will result from any model where shareholders have all the bargaining power and the treasury is held hostage to those shareholders. In this case, the treasury will basically have to pay. And of course, the result is the one you expect. If you pay whenever there is, if shareholders are not penalized whenever there is a crisis, then of course there are no incentives for shareholders to arrange the right managerial package that will provide the right incentives. So this clearly is a way to provide incentives for shareholders to take high risk. More interesting is the case of cost minimization, and then we have to consider the expected present value of the two strategies. So we take the point of view of shareholders and consider two possibilities. We may offer an incentive compatible mechanism to the manager, or we may let the manager get the private benefits it gets from having the high risk. And when you compare the two, you simply obtain that in some environments you will have one type of behavior, and in the other environment you have the other. And as you may imagine, if private benefits are very high, then there is a tendency for shareholders to prefer that their bank manager takes high risk. And so in this way reduce the remuneration, simply because they don't take the full amount, they don't take into account the full amount of damage that they are creating. But even if we have this scheme whereby the manager offers the right incentives, then what we discovered is that it could be interesting to have a grace period whenever we change the manager. So in the case we have high reservation utilities for the managers, this means that the initial contract implies a golden handshake. If there is a golden handshake, rather than a golden handshake, let's have a grace period, and let's have instead of a golden handshake, the equivalent amount of the golden handshake would be given as a bonus if the bank succeeds, and as zero if the bank, so that the expected value would be the same. Well, this will be efficient indeed, but it implies intervening in the manager remuneration. And so that will be precisely what we obtain in the optimal contract. So for the first period, the manager is kept with probability 1 and guaranteed a continuation utility irrespective of its current performance. And then for all other periods, the manager is fired with probability 1 if there is a crisis and is kept in office otherwise. And so what this means is that it's impossible to find a contract that is efficient and where there is no intervention regarding the managerial package. So that's the main message we have here, that taxing systemically important financial institutions is not enough, that in some environments simply shareholders and therefore managers will prefer to go for the high risk and low managerial compensation cost. And second, even if this is not the case, after a crisis, when we have a new manager, there is this grace period, and this would imply an intervention. A governmental agency should intervene in setting managerial compensation. Thank you.